Very good afternoon to everyone. We're starting with what the forex part, right? The basic rules of forex, right? So this is the chart of forex. If you ask me from where questions are asked, right? The majority questions, if you see, right, are based on what your forwards and money market hedge. One question has to come in the exam from this. Somewhat what? Tell me. Compulsory to have one question from what forwards and money market. Hey, guy also sent you on this no. Forex notes did I send you? देखो जरा. Okay, I've sent all the notes. Chalo, quickly join in. First, you go through what the currency conversion rules that are there. So the rule one says quotation. So generally, you what first rule if you follow everything else is put on place. So what is the first rule? Secondary currency by base currency, correct? How many of you? I don't know. How many of you know these rules? I don't know, right? Yeah, mostly section B question, one section B question, two section B questions, or at times all three section C questions. Section B questions have been from these three chapters. So don't be surprised if you see a section B question on, correct? Have a look. So first is quotation identification and rearrangement, right? Always write the quotation in what secondary currency by base currency. What is secondary currency? Secondary currency is generally n units. Base currency is generally 1 unit. So when I say $1 is equal to rupees 82 or 84, whatever it is, correct or not? In that case, I mean it is a rupee by dollar quote. N could be more than one, N could be less than one, correct or not? These are the quotations that you generally these rates, right? Or the quotation has to be written in secondary currency by base currency, right? Secondary currency by what? Base currency. Have a look, right? Secondary by base currency, correct? Then your currency exchange. Rule one is what? Always convert a quote. So if I say that $1 is equal to 0.7536 euros or pounds, whatever you want to say, correct or not? In that case, tell me the quote is pound by dollar or dollar by pound. Tell me. Like this, 1 pound is $1.2465, right? Or 1 FF. Tell me what this quote is. 1 FF is equal to 0.456 GG. Means is it a GG by FF quote or FF by GG quote? Tell me. So currency is not at all important, right? Currency is never at all important, correct? GG by FF, correct? That is how it will happen, right? GG by FF, secondary currency by base currency. That is rule one. Then rule two is of currency exchange. Currency exchange is what? Now, when you have written the quote as what? Secondary by base. If you want to convert secondary to base, that is left to right, you will do what? Divide. And right to left, if you want to do base currency to what? Secondary currency, you will multiply. Correct or not? Right to left, if you go, that is base currency, if you have to convert. So any $10,000 if I give you, you want to convert it in rupees, you have to multiply by this rate. Correct? Rupees, if I say 10,000 rupees I want to convert to dollar, then you will have to rupees 10,000 divided by this 82.5. Correct or not? Have a look. So irrespective of whether you are buying the rupee or buying the dollar or selling the rupee or selling the dollar, correct or not? Anything, right? Irrespective of buy or sell. So I have written what? Irrespective of buy or sell position, if I want to convert rupees to dollar, I will have to or secondary or base currency to secondary currency divide, or secondary currency to base currency divide, base currency to secondary currency multiply. Correct? Have a look. We have done this part. Rule one, rule two. What is rule three? Correct. Rule three is basically your rule of what? Tell me. Rate determination. rate determination rule. Some books, old notes, maybe rule 3 and 4 might be exporter and importer. But now I have rearranged the rules. The rule 3 is rate determination. Correct or not? If there is a bid ask rate, then there are two types of rates. Spot market ek hai, and there is forward market, that is another part. Forward is today you decide a rate for a transaction in the future. Correct or not? Forward rate, right? That is how it is. Then rate determination, rupee by dollar and dollar by what? Tell me, rupees. Right? So if you want to buy one currency, you have to sell the other currency. And if you want to sell one currency, you have to buy another currency. Generally, base currency, if quotation is there, base currency, you will have to buy, then you will have to buy at a expensive rate. If you have to sell, you will have to sell at a lower rate, the base currency. But if the buy or sell logic is given in rupees, so I will convert rupees by, that only means sell dollar means lower rate. That is how it is. Have a look. This is the basic part. Have a look. Buy rupees means sell dollar means lower rate. And also, then rule 2 will also come. If I want to convert rupees to dollar or dollar to rupees, what it is, you have a look at it. Accordingly, rule 1. So first rule 1 will apply. You write the quotation correctly. Then you will say what currency is to be converted to what currency. You will take that, and then you will come here. Whether rupees to be bought or dollar is to be bought, or rupees to be bought and dollar is to be sold, cheaper rate. Rupees to be sold, dollar is to be bought, expensive rate. Correct? Have a look. If still you have problems in this, I may have one YouTube video where I have done basics of this rule 1, 2, 3. If you are still confused on what, or your forex seems to be a difficult nut to crack, right? Still, I have a 2.5, 3 hours video of what these basic rules, which will help you understand what, tell me, the basics of forex, right? Because still you are not very confident with conversion. Forex is very difficult. Rule 4 is what? Generally, you have what? One theory question based question is what? Exporter is happy when foreign currency strengthens or home currency weakens, right? Because he will get profit. But he is always worried about what the foreign currency weakening or home currency strengthening, where he faces a loss. Right? Then rule 4, exporter or foreign currency receivable or exporter, right? If he is Indian, he is selling goods to foreign buyer, he will receive foreign currency. That only means he will sell the foreign currency. That only means he buys home currency. These two things are one and the same thing. Two parts of the two ends of the transaction. Correct? Exporter wants to sell, or he could say he wants to buy the home currency. Correct or not? Exporter sell goods to foreign buyer, receive foreign currency, sell foreign currency, because he cannot do anything with the foreign currency in his home country. Importer is worried about what? The foreign currency strengthening or the home currency weakening, right? Because he will face losses. Importer is what? Tell me. Foreign currency weakened, he will be very happy. Home currency strengthened, he will be very happy. Correct or not? Have a look. Then you are what? Importer buys goods from foreign seller, pays foreign currency. He has to pay foreign currency, but he does not have that foreign currency in his home country. So he has to buy the foreign currency. That only means he has to sell the home currency. Importer. Correct or not? Buy goods from financial statement or for not financial statement, but foreign seller, correct or not? Then exporter. Now see, if I'm in India and the billing that I do either as an exporter, right? If it is in foreign currency, I am having the foreign risk. But the what USA buyer, correct? If I'm an Indian exporter and I'm doing billing in dollar, then foreign currency risk is with me. But for the USA buyer, there is no, for the USA importer in this case, there is no risk, correct or not? Other way around, I am an importer in India and the invoice that I received from a USA what exporter is in dollars. That means I am facing the foreign currency risk. He is going to receive. He does not have any foreign currency risk, correct or not? Right? And basic of forward is what, tell me, is something called as a forward market, where today importer exporter who has foreign currency payable or foreign currency receivable and is worried about what FC strengthening can enter a contract with a bank or financial institution today, locking a forward rate. So what you will do? Basically, you will lock a forward rate. That means on the transaction date when you come, right, with the transaction or with the invoice, right? Then at that or whatever rate you decide today, the rate or the transaction will be executed at that rate. Correct or not? Generally, you will see a single rate for seller buy. That means rule 3 will not be used. Somewhere bid ask rate will be used. You will use what? Tell me. Rule 1, 2, 3, 4, 5. So I have written here. If single rate is there, then use rule 1, 2, 4, and 5. But if there is bid ask rate, then rule 1, 2, 3, 4, 5. Right? Forward contracts are generally over the contract or over the counter contracts, correct? Sure. So a forward, how does a forward work out, right? So now say company has exported goods. Exported goods means it is going to receive $0.45 million after whatever 3 months. So today only a 3 month forward can be entered with you by you with the bank, where the rate given by bank is 1 rupee is equal to $0.113. So is it a rupee by dollar quote or a dollar by rupees quote? Tell me. 1 rupee is equal to 0.0013 dash $0.0129. What is the quote?
Dollar by rupee.
Dollar by rupees. The quote is dollar by rupees, boss. Correct or not? Right? So you apply rule 1, then you apply rule 4, where you say what? Export foreign currency receivable. So you will sell foreign currency. Here foreign currency is dollar. So you are going to sell dollar. That only means you are going to buy rupees. You are going to buy the base currency. Base currency buy always will be at a higher rate. Then you will do rule 3. Rule 2 rather. Rule 2 says you want to convert dollar to rupees. That means left to right. That means you have to divide. So $450,000 divided by 0.0129 gives you 3483721 rupees, right? You can do a lot of practice of this if you have not yet. Then coming to what? Forwards, right? For importer has 15,000 euro payable for an import after 2 months. So a 2 months forward is 1 rupee is equal to whatever euro that is given. So is it a rupee by euro quote or euro by rupee quote? Tell me, which is the best currency?
Euro by rupee.
Euro by rupee quote, right? And it is what? Bid ask spread. So first rule 1, if you follow, everything else falls in place. Then it is an importer or an FC payable. So you say rule 5, importer buys goods, pays foreign currency, does not have the foreign currency in the home country. Therefore, he buys the foreign currency. That only means he sell the rupees. So rule 2 and 3 says what? Again, rewrite the quotation, buy the euro. That only means sell the rupees. If you sell the rupees, you will get the lower rate. And you want to convert what? Euro to rupees, you will divide. Most of you have this problem, don't understand this quite or are not quite comfortable with forwards or using these what rates. Chalo, even if you know forwards, the next part, tell our students what is the next part that is difficult. Bolo iske baad, tell me. मनी मार्केट है पहले ये कर लो थियरी क्वेश्चन टाइप्स ऑफ फॉरेक्स रिस्क ट्रांजैक्शन रिस्क एंड इकोनॉमिक रिस्क right importer exporter generally have transaction risk today they what do purchase or sell and have to pay a foreign currency at a later time. It is a cash risk and it is generally short term in nature. Translation risk is when subsidiary is in some other country and holding companies in some other country and you have to find a or you have to make a consolidated financial statement of what the whole group, and in that case you have to convert the whole what transactions from one currency to another currency during that time, right? What rate to use? You will use different rates for different assets and different liabilities, correct? Right? But actually, no money is transferred from here to there or there to here, correct? Hence, all these what differences will be taken care through a foreign currency translation reserve account, correct? And it is a non-cash risk generally. Then economic risk is a long-term transaction risk because of what economic changes in a country leading to what foreign transaction being unattractive over a period of time. I've given a good example. First, you used to sell mangoes for $10. Now you sell it for $100, right? Your inflation rate in your country is very high, but the opposite country it may not be so high, and hence it may not be very what advantages for them. Then coming to the what money market hedge. Tell me, do you remember the story, everyone? Money market hedge story. Those who have done it with me, how is the money market hedge story going? Tell me. Exporter, sorry, importer. Does he wear shoes or go on a cycle? Tell me. Bolo. Importer. Which shoes does he wear? Tell me. IBB or BSI?
Nike.
कौन से Nike के shoes? Which has written IBB या BSI? Tell me. Importer.
IBB.
Importer.
Exporter. Exporter goes on a cycle. What is written on the cycle? Tell me. BSI cycle. Correct or not? Tell me. Everybody remember this? These are the steps of money market hedge. See, what is money market hedge basically? Correct? Now see, generally you are given forward rates by the bank, but can you manufacture a forward rate in-house? Yes. Right? By using what? Tell me what? Bolo. By using what? The borrowing and depositing rates, correct? And also the spot market. You can manufacture what? Tell me the rates. बराबर है क्या? देख लो. ठीक. Now let's go to MMH exporter. The story is what? Tell me. An exporter is going to receive some amount after 3 months, some foreign currency, correct? So he says what? I cannot wait for 3 months. I want that money now, right? So the exporter goes to the bank and says, boss, I don't know anything. After 3 months, correct? After 3 months, I will get this money, correct? But I want this money now, right? So bank says, no problem. Take a loan from us. And he goes to the foreign bank, correct or not? So generally, he borrows the present value, right? So what does he say? 150,000 after 3 months I will receive. I want to borrow some lesser amount, which will turn to 150,000. So when I receive 150,000 from my customer, I will pay you that 150,000, correct or not? So I have written parallel transactions also. So you borrow the present value of 150,000, which is to be paid after 3 months. The present value, that is today's value of 150,000 at the FCBR, foreign currency borrowing rate, correct or not? 150,000 plus or divided by 1 plus the borrowing by 12 into the N is credit period, correct? You get $14883.37 you borrow today, correct? Right? And when you get the 150,000 from your foreign, what? Tell me. Customer, you will pay that 150,000 to the foreign bank at the end of transaction period. Now you have, because it will mature and become 150,000. So now you have $14883.37 right now in India, correct? But you don't know what to do with this money, correct? You could use this 14883 into your business, but dollar your business or your business works on rupees. So you go to the spot market and say that I have 148,883.37. What should I do with it? They say no problem. You want to do what I want to have rupees right now. So sell the foreign currency. So first spot is, or first step is borrow foreign currency. Second is sell the spot or sell the foreign currency in the spot market. Get the home currency. Now you could use this in your business, right? You can invest this directly into your business. But the basic objective of an exporter or an importer, or for an exporter, is to know how much home currency you will receive after 3 months. So you deposit this home currency that you have received in the home currency or home country HCDR, that is home currency deposit rate. You deposit it, right? And then you get certain rupees after 3 or 4 months, whatever, after credit period. And that is your what? So we can say that company will receive 13193,151 rupees, right? So here you find what future value of the amount that you invest today, right? 150,000 receivable from the USA buyer. All this is known today. So what do? Have a look. You invest it, and after 3 months you get this much money. Correct or not? So your transaction is fully covered. In short, right? This is what is it is in short. Step one, right? Whatever foreign currency receivable, right? You borrow the present value of the foreign currency at foreign currency borrowing rate, which will become FC receivable at transaction date. So you do what? FC to be borrowed today is equal to FC receivable at transaction date divided by 1 plus FCBR divided by 12 into credit period. Sell the foreign currency borrowed today in the spot market. The foreign currency borrowed, there step one answer, multiply divided by the rate that is there. Then invest the home currency received today at HCDR, home currency deposit rate, right? So whatever HCDR you have received from step 2, deposit it and get the amount that you will receive after 3 months or 4 months, right? Questions have been asked asking you step 1 ka answer, step 2 ka answer, step 3 ka answer. So accordingly, please read the question properly what they have asked. And very simple if you want to put it correct. Take a minute. I have solved. If you want, you can solve all the questions. I have solved, I think, all questions of MMH that are there in the book. Correct. Ekdam short way if you ask me. Borrow, sell, invest. First step is present value of the foreign currency receivable after 3 months. And last step is finding the future value of the home currency that you invest today. And in middle, you have to sell the foreign currency. Now, how you remember this? It is your. We did in class that exporter goes on a cycle which has a trademark of BSI, right? And then importer, right? Importer. Analysis में बाद में आते हैं importer. What is up about importer? Importer wears Nike shoes of IBB because he's running everywhere. Why? Because importer is going to receive 75,000 or whatever amount after 3 months. Correct? Or no, he is not going to receive, he's going to pay, right? But he tells the bank that boss, I'm not going to wait 3 months to pay the amount. I want to pay the amount now. Correct or not? Right? So bank is okay, right? So you give me 75,000 to pay after 3 months is what they tell to the bank. Bank says okay. You invest some amount today which turns to 750,000 that you have to pay after 3 months. We will give you 750,000. Like okay. If I have to invest today, find the present value of 750,000 payable after 3 months today. If you get the value comes to 743. So bank says no. We will give you 7, or if you give us $743,494 today, right? We will give you 750,000 at maturity, right? Okay, which you can directly pay to the USA seller. No tension, correct or not? Like okay, but the bank says last with 743, give me 743, whatever 494. So like no sir, you use the FCDR rate to find the present value because you want to know 750,000. How much you need to deposit today? That will turn into 750,000 after 3 months, right? Then 743 something. You need bank, you are late to the bank, I don't have this money. Okay, go and buy from the market. So you go running wearing your IBB Nike shoes, correct or not? Sorry, but this is how you remember it, right? Picturize an importer wearing what? Nike shoes because he has imported those shoes, right? And it is written IBB on that, correct? Sorry for using all these terms, but this is the most easiest way you can remember this. There is no other way to remember it than this, correct? So now what is happening? You need $743,494, correct or not? You go to the spot market and say, boss, I need $743,494. Okay, no problem. For that, right? If you want to buy the dollar, that means sell the rupees, right? Whatever it is, right? You will require 60. How much liter, Baba? 65,218,772 rupees, correct or not? Right? But you are like, boss, rupees also I don't have. I can take from my business, right? If my business has that much money, I can take from my business, but I don't have this. So you go and then run to the local bank and say, boss, I need 65218,772 rupees. They're like, okay, we will borrow it to you, right? And this borrowing will mature after 3 months or whatever the credit period, right? And so accordingly, you'll find the the end map payable will be 6684921. But what you'll do, you're borrowing 65218. You'll take that, keep it in your bag, go running to the spot market with your Nike IBB shoes, get the dollar and then invest the dollar in what? The foreign bank. Here, in the home bank, you take the loan and invest in the foreign bank. So logically, it is a IBB Nike shoes. What is IBB? Have a look. Short my note we have written. Correct. Ajab. See, the impact, I am telling you this, correct? This impact when you are in class and when you are writing with me the whole story, that impact is completely different. Those who have done that have not even a single percent problem in money market hedge, right? So step one, what is step one? FC to be invested today, you find the present value, the payable amount ka present value today. FC payable divided by 1 plus FC DR by 12 because you are going to deposit that money into credit period. But sir, this FCI do not have with me. No problem, buy it from the spot market. You go to the spot market says that foreign currency you have to buy, right? You need home currency, but home currency you don't have. You borrow the home currency from the HCBR using the HCBR home currency borrowing rate and see how much is payable after 3 months. You're like, okay, we'll see after how much is payable. Take that rupees, go to the spot market, execute the transaction, take the dollars, pay it to the or invest it with the bank, right? So bank ka investment when it gets matured, you can pay that amount to your what seller, right? The foreign seller, and then you have to pay rupees, correct? When it gets matured. So IBB, invest, buy, borrow. For exporter, it is BSI, right? If you remember, step one is always getting the present value. Step three is always getting the what? Future value. And here sell for exporter and buy for. This is how it is. Have a look. We have solved almost every question that is there in the book, right? About this. Then in between analysis of MMH, correct? Now see after step 2, as an exporter, if you need the money and you want to invest in the business, it is allowed. Or if you have shortage, you can invest it into the business. But the objective is to be followed. So you generally what invested somewhere outside. As a FC payable, if you have that rupees, whatever or home currency, payable to buy the foreign currency. If you have it, you great. Naito, you can what? Tell me. You can decide to borrow this money in home currency, right? At the end, also you can compare the MMH receipt or payment with the forward receipt or payment and try to get the better answer. Then whatever NFC receivable or payable divided by the home currency receivable or payable will give you what the implied MMH rate, which you can directly compare with what? Tell me the forward rate. Then coming to derivatives. What are derivatives? Tell me. Derivatives are instruments which derive their value from underlying asset. There are two different markets, that is derivative market and actual market. Correct, bro? Underlying asset from underlying asset means very simple. Before I forget, if any of your friends, family, or anyone wants to what register themselves with ACCA, we are now an authorized learning partner, and now we can do registration ourselves, right? And two or three things before I go ahead, right? At our academy, you don't have to pay as a full 8 paper, 13 paper ka fees or anything of that sort. One paper at a time you have to pay. So whoever wants to start will get all the what discounts and all those stuff normally ALP gets, right? So we can do the registration ourselves, right? If any of your friend is in your SY BCom with you and wants to do the course, right? Right now we are having what? Even if it is from a BB or some background, we are also running FAMA batches. So if anyone wants to do FAMA, BT or something of that sort, we are up for that as well. Okay. So if any of your friends, even we are running skill and P level, obviously, right? We are running knowledge level batches from 10th of September right now, 10th or 12th के आसपास. So I would recommend if you have any FA batches starting from 10 September, right? And from 15 September, we'll be starting FR, FM, UK tax, okay, by AFM, SBR. These many batches we are starting. PM we have already recorded, ATX we have already recorded classes which have been done for PM for this September attempt we have done, that is recorded. I have taken PM. ATX I have taken for the last quarter, which recorded is there, right? So those will be guided recordings, right? So if anyone is interested, kindly let us, correct? You have all have my number, correct? You can give my number to them. Those who want to start new ACCA, we will. So it will be done at a very low investment. That is that. Okay. Sure. Coming back to derivatives, right? Derivatives are instruments which derive their value from underlying asset. There are two different markets: derivative market and actual market. Two are completely different. Actual market where you just go and have a look and try to see what is the rate of the underlying asset. Underlying asset could be anything, onion, potato, whatever, right? And then from this you derive a value, correct? That was right now onion is sold at 10 rupees. Now in the future it will be sold at 11, or after 3 months, right? It will go to 12 rupees. So you should take some promise, right? That is there. So if you ask me for futures, you need to only understand one thing, that what it is nothing but promises are exchanged. Simple and sweet. What are exchanged? Promises. Simple. You give promise, you take promise. So on the date of the transaction, you close buy. If you have bought something or if you have done a promise to buy, you will have to close it with promise to sell. If there is any promise to sell, you will have to close it with promise to buy, right? So I have given one example. You can have a look at it, right? Actually, no onions or no asset is sold, but it is nothing but bidding of prices, correct? In derivatives, you do what? Bid on prices, right? Then there is something called as basis, right? Forward or futures are generally based on actual market, right? So the futures sometimes, right, become equal to the what? Spot on the expiry date. One MCQ is there on that also. Then currency futures wala part, correct? If you are an exporter, you will sell foreign currency future now. That is promise to sell foreign currency future for a date in the future, but you decide the rate now, and on the transaction date you close by buying the foreign currency. So if you sell at 10 and buy at 15, there is a loss. If you sell at 15, buy at 10, whatever is the rate of foreign currency, there is a profit. But the profit loss ka zyada detail mein there, I don't think they are going to ask you. But still, I have taken one example. You can have a look at it. For an importer, he would want to what? Logically, will do a promise to buy the foreign currency future, correct? And close by what? Selling the foreign currency futures on transaction. Have a look, right? One example is there in the book. If because one somewhere in some books they have given that example, so I have taken that example. But generally, examiner is very clear that practical question on futures and options will not be there, right? Then there is something called as purchasing power parity theory. Triple PT theory. What does triple PT theory say? Right? That in the long term, pehle to theory, that any basket of goods, right, will have the same value all over the world depending on spot rate today. Correct? Everything, every basket of goods have the same value, but in reality, this is not true. Correct? And the currency or country with the higher inflation rate in the short term and containing will have a weakening currency over the long term compared to currency having lower inflation rate. Correct? So where inflation is higher, that currency will devalue over the time against the currency which has lower inflation value. This has been asked in a lot of MCQs. Then there is a formula for triple PT which we derive in class. Triple PT formula is what? Triple PT helps you find the expected spot rate. Expected spot rate ES1, correct? ES1. S1 means what? S 1 year, correct? S0 means what? Spot rate today, right? So spot rate today to 1 plus inflation rate of the secondary currency. This is how you remember it. In the numerator, you will have spot rate of or inflation of secondary currency divided by inflation of base currency, correct? ES1 is equal to S0 into 1 plus secondary or 1 plus what? Tell me. secondary currency by 1 plus inflation of base currency. Correct? That is how it is done. If it is 1 year, 2 year, 3 year, you will do raise to 1, 2, 3 to find the 2 year or 3 year rate. But when it is 6 months or 12 months, so I've given a table here. When asked for S1, S2, right? Then what will you do? Raise to N. But when asked ES 6 months, 3 months, in that case you will do the yearly rate by 12 into the number of months. Correct? That is how you do. I've done 2-3 questions here. You can check that. Right? Different books have different answer. This is the standard that you can follow. And you solve any question, everything will match with this table. Right? You will get tables for almost everything in my class. Correct? This triple PT, most of the questions I have done in class. Right? Then options. What are options? Options basically shield you from losses. Correct? So there are two types of options. Call option means right to buy an asset, and put option means right to sell a asset. Asset is nothing but foreign currency. Here, option has one peculiar thing, that you have to pay premium. You have to do what? Pay premium. Pay premium means what? Tell me. See, basically what you do? By paying a premium, you are basically restricting yourself from any losses. Correct? So premium payment means what? In options, you will never have losses. Wherever you have losses, you can have the option and go in the market and do the transaction. Correct or not? So, for an exporter, he will receive foreign currency, he will sell foreign currency. That means he wants a right to sell foreign currency. That only means a right to sell option is a put option. So, exporter will always buy a put option. Correct or not? And he will pay a premium. Hence, what will happen? Let's say he decides that he will sell at 78 rupees, and on the market or in the transaction rate, market rate is 76 rupees, right? He would rather sell at 78 rather than selling at 76. So he will exercise the option and force the opposite person to sell at 78. But if in the market everyone is selling at 80 rupees and he is at 78, then lapada. Then what he will do? Better to sell it at 80 rupees in the market rather than at 78, right? So he will lapse the option and sell it into the market at 80 rupees. Then coming to the importer will pay foreign currency. That only means he has to buy foreign currency. Correct or not? Tell me. क्या आवाज नहीं आ रही है?
Yes, sir.
Very less.
No, sir. Fine, sir.
Fluctuating moksha at your end, there might be some problem. Right? Importer pays foreign currency. That is what? Buys foreign currency. If he buys foreign currency, there is a right to what? Buy foreign currency. That is what? If he wants to right to buy, should you take a call option or a put option? See how you remember it. Okay. See, if it is a call, you pick up the call. Okay. So this is what you are buying something. Right? If you are putting down the call, that means what? Tell me. You are from your pocket, you are selling something. This is how you remember most toughest of the toughest things in this world are remembered by easiest of the easiest or stupidest of the stupidest. What meaning? अभी क्या there उसमें कुछ meaning है क्या? Tell me. Nike shoes which has IBB logo on it. No meaning. BSI cycle. No. But students remember it in the exam. I have seen students. AFM में we do this a lot. Okay. So AFM में right all students, 1 or 2 students who have done class with me, right, said that sir everyone is saying with us because we are doing this. Put down the call, take the call. Correct or not? AFM में तो this solving का है fully, right? So we do this quite in detail. मतलब I think we invest what 10 hours, 10 to 12 hours for futures, 10 to 12 hours for options, right? We solve each and every question in class for what? AFM, foreign exchange risk and interest rate risk, correct? Right? So for AFM, what we did this time around is the whole exam kit only we solved, right? Section A and B, there's only section A and B question, correct? So we solved every question that is there in the, correct? Take buy a call option. Buy a call option means right to buy the foreign currency. After 3 months, at rate decided, you will pay premium. So you get a king station or king stature. You are buying at 78. Now if the rate goes to 76, would you want to buy at 78 or 76? 76, correct. It is cheaper in the market. So you will lapse the 78 option and go in the market and what? Tell me. Buy it at what or sell it at? No, sell होना चाहिए ना. ठीक है, whatever. Correct. At a rate of 80. ठीक है. Then currency options let you enjoy the profits. Correct. ठीक. बराबर है. let you enjoy the profits and save you from the losses. Insurance policy. बराबर है क्या? देख लो जरा. Indian exporter put option importer का. ठीक है, you can have a look. IRPT interest rate parity. What is IRPT? IRPT helps you find what? Tell me. If the theory is to be taken, if you want to borrow any money from anywhere in the world, the amount of the real rate of interest all around the world is the same, right? The nominal interest rate all around the world or in different countries depends on the inflation. Real rate is same all around the world, correct or not? Right? Right. So, and then also the nominal rate is decided as per inflation in each country, right? And nominal rate and the country or currency which has higher interest and inflation rate is, so wherever inflation rate is higher, they will have a weaker currency compared to what the inflation rate in the or lower inflation rate countries. Country with lower interest rate or inflation rate will have a powerful currency, no problem. Nominal rate are nothing but real rate plus the inflation impact. IRPT helps you find the expected forward rate, EF0, today's forward rate for a transaction after 1 year. So it will be S0 into 1 plus the interest rate of secondary currency divided by 1 plus interest rate of the base currency. So if anyone tells you that same cut copy paste thing, right here, that if anyone tells you same that 1 or 2 year if you have to find, you have to do raise to n. And how do you remember this? Rupee by dollar, rupee ka interest rate will come up and dollar ka interest rate will come down. But if it is 3, 6, 12 months, then whatever yearly interest rate by 12 into 3. Correct or not? Have a look. I've solved each and every question. I've tried most of the questions that are there. I've tried to do it. Right? Then triple PT and IRPT. When I open up IRPT, IRPT is made up of real rate into inflation rate. Correct? 1 plus real rate into 1 plus inflation rate. Right? Then in that case, what happens? Have a look. Right? Right? Then you open it up. Real rate, so all around the world is same. So this real rate and real rate will get cut. So EF0 is equal to S0 into 1 plus inflation by 1 plus inflation secondary by base. Either भी वो same है. If you divide both of them, then it will so come that ES1 is equal to EF0. Right? This is called as expectation theory. That in the future, ES1 will be equal to EF0 1 year. Right? And then you have your Fisher effect here, which helps you negate this into four-way equivalence theory. Then there is internal method. Internal method dealing in the home currency. Don't do foreign billing at all, right? Or don't accept bills in foreign currency, right? Then leading and lagging. इधर देखो leading and lagging के लिए Indian importer pays foreign currency, right? He will try to lead the payment. Means what? Pay early, right? USA seller will be very happy. Someone is paying early. He will allow it, correct? And Indian importer, if he is worried that if he waits and foreign currency strengthens, then problem. So Indian importer may use leading, right, to pay the USA seller. USA seller will be more than happy, correct? But if an Indian importer tries to lag the payment, that means make it late, generally USA seller will not be very happy and he may not allow, correct? Because on transaction date, if a foreign currency is strengthened, lagging may not be that much useful, correct or not? Have a look. An Indian exporter, Indian exporter, he's worried about home currency strengthening and he says that he will lead the what? He wants the money early. USA importer may not be very happy to give him the money earlier. But Indian importer says, please pay late after 60 days. USA importer will be very happy. You will find this nowhere in any book. I am sure about it. This table, I am very sure you will not find anywhere. My guarantee. Ask the students. Nowhere you will get this table. 100% nowhere. Then comes the part of swaps. Correct? Currency swaps. These once you can have a look. I have not seen any question on currency or forex swaps being asked in exam. One part of forex का one futures and option का part. This is my notes only. I have made these notes, correct? Forward, future and options के बीच में difference. Forwards are more time consuming, futures are less time consuming, options are less time consuming. Because in forward, generally you go to the bank, you give the what? invoice, do the calculation, come back with the forward rate, right? So it is time consuming. But future is on the stock exchange. Options are generally on the stock exchange. Forwards are in a lot of currencies because it is actually transaction based. Future is not transaction based, option is not transaction based. Future and option means there is a contract based what payment system. Future and options are generally for bidding. Forward is for actually covering your transaction. Forward may there can be profit, there can be loss. Future may there can be profit, there can be a loss. Option may never ever in your life are you going to face losses because it is an insurance policy. Then forward is suitable for small amount of currency. Future always for big amount because you are actually not going to pay the currency. Only the differences are going to be paid. Correct. Then contract size is not applicable in forwards, but in futures and in option contract size is applicable. Right. Then forwards are generally OTC, that is over the counter transactions. Futures are generally exchange traded. I told you on stock market. Right. Options can be over the counter as well and exchange traded as well. Forwards are generally transaction based. Your futures are generally future and option are not transaction based because they are on the stock market. That is there, right? Then you have what? Tell me. Right. Then you have what? Counterparty risk. That forwards may you could be if you are in losses, you would what? Not go and honor the contract. But in future and option, stock market only closes the transaction, right? You are, so there is no counterparty risk as such. Forwards mean there is no cost. In future, you pay margin money. In options, you pay premium. Correct or not? Then forwards are comparatively less flexible. The date on which it is written on the contract, that date only you have to come and honor the contract, right? And when it comes to future and options, are more flexible because you can go anytime and exercise the option or close the future transaction. Mind you, almost 7-8 MCQs are on these 2 pages. If you have seen MCQs, have you seen MCQs on this?
Yes, sir.
If you know these 2 pages, I think somewhere around 7-8 MCQs are based on this. Theory MCQs. Right? This is nothing but your what? Tell me. Foreign currency risk management. Forex risk management. Quickly come into what? Your interest rate risk management. What is your interest rate risk management? Have a look. When does interest rate risk arise? Now see, if I want to borrow or deposit today, is there an interest rate risk today? If I want to borrow or deposit today, no. If today I know that after 3 months I need money for next 6 months, after 3 months for 6 months, in that case, today borrowing rate is 7%. Everyone is saying that in 3 months this will go to 9%. Then only I will have what? Tell me, interest rate risk. So whenever the borrower requires money after n months and it is expected that borrowing rate will go up, then there is an interest rate risk. A depositor knows that after 3 months he is going to deposit some money. Right now the deposit rate is 5%. Everyone is saying it is going to go to 3%. That is when you will be worried. When depositor will get money and invest after n months and it is expected that deposit rate will fall, then there is interest rate risk. Today, if you borrow or deposit, there is no interest rate risk at all. Correct? Then types of interest rate risk. You have what? 2 types, or first types of interest rates are of 2 types: fixed interest rate or variable interest rate. Correct? Basically fixed over the whole period, and variable interest rate will depend on some basis. Correct? Central basis what? Sometimes you have a base rate or a LIBOR or MIBOR. LIBOR is what? London Interbank Operating Rate. MIBOR is what? Mumbai Interbank Operating Rate. It changes as per what the policies of the government and the RBI rates changes. Correct? Your interest rate choice. Borrower, if he feels that the rate will go up, then he should borrow fixed. Right? And borrower, if he expects rate will go down, then what he will do? He will borrow variable. Depositor, if he expects the rate will go up, then he should deposit at variable. But if he expects the rate will go down, deposit at fixed rate. This table also nowhere. Types of interest rate risk. Correct? There are 2 types of interest rate risk: basis risk and gap exposure. Basis risk says what? Sir, whenever you do variable pay deposit, take a loan at variable rate, right? Some variable rates are based on central what? Tell me, bank rate, and some are based on state bank rates, correct? So there might be different bases on which variable rates will be decided or based on. Hence, there is a risk of a basis risk. Gap exposure is, now see, whenever you deposit money, you pay or you receive interest on it, right? And whenever you borrow money, you pay interest on it. So whenever you deposit and you receive interest, right, the deposit amount or the interest received are called as interest sensitive assets. Whenever you borrow money and you have to pay interest on that, right, it is called as interest sensitive liability, correct? So whenever your inflow of what interest received is more and outflow of interest payable is less, there is a positive gap exposure. Other way around, liabilities are more, assets are less, negative gap exposure. This is gap exposure. Section C, man, this is not important, but A and B, man, these questions, right, are asked. You must have seen MCQs on this, correct? And then you have something called as forward rate agreements, correct or not? Have a look, right? FRA, forward rate agreements. What are FRAs? There are forward rate agreements. FRAs are what? You are worried as a borrower. After 3 months, you require money for 6 months. You are worried about the rate going up. So you go to the bank and say that, boss, I am worried about the rate going up. So they give you a what? After 3 months for 6 months means it will be a 3v9 FRA. 3 or the first 3v9 my first N is nothing but the number of months at which or end of which the loan will start. And 3v9 FRA means the loan will be repaid from today on what date. So 3v9 FRA, correct? Then if the rate goes to what? 10%. You thought it will go up. So 8.25 ka you took a borrowing pay FRA, right? So if the FRA rate is given such, dekho zara, 1 minute, sorry, wait. Forward rate agreement, 10% per annum, correct? Right? You won the bet because in the market the rate is 10%. You have a contract to borrow at 8.25. But what does the bank say? Arey Papa, we have RBI guidelines. RBI says if the market rate is 10%, borrowing will happen at 10%. But we understand you have won the bet. We will pay you back what? The difference amount. Correct or not? Have a look. Payment and received. So you see, no? See, who the borrower is worried about what? The interest rate going up. So from 8.25, if it goes to 10, that means his whatever he worried about has gone true, and he will still pay 8.25% only net. Correct or not? Have a look. Have a look. So if it goes to 6%, that means he would have said, Baba, I would have not taken the FRA. Better I would have borrowed from the market. The bank will say no. 6% by borrowing, plus you have to pay difference of how much? 2.25%. Correct or not? Have a look. 10 million into 2.25% into 6 by 12. Right? Then come to the notes. Here everything will be clear. It is an agreement where an interest rate for borrowing or depositing for a future rate is fixed today. The borrowing or depositing is decided by an agreement at a fixed date in future and over the counter. FRA quotations generally are 4v9, that is loan or deposit will start after 4 months and end after 9 months. So 4v9 is what? Tell me. At the end of 4 months for 5 months, right? Right? Then on transaction date, borrowing or depositing date, borrowing or deposit will happen at market rate. And the difference between the market rate and FRA will be either you pay to the bank or bank pays you. So borrower table, have a look. You wanted to ask who pays whom? Have a look. This is the table. Who was asking, Baba? Ritika. This is the table for a borrower. If FRA rate is greater than the market rate, you have lost the bet. If FRA rate is lower than the market rate, that means market rate is higher, your FRA rate is lower. Okay, great. We will, or net you will pay FRA rate only, correct? You have won the bet and bank will pay you. Depositor, FRA is greater than market rate, you have won the bet, right? Bank will pay to us. And FRA is less than the market rate, you have lost the bet, correct? And I have done all questions of FRA also, most of the questions I have done in class. Then there is something called as IRG. What is it called? IRG, interest rate guarantees. IRGs protect you from what? Losses that may happen in FRA. So FRA, what happens? You have generally losses that will be avoided by IRGs. But it gives you an option to lapse the option when there is a loss. So logically, this is what an option. So IRGs are option over FRS and let you enjoy upside without worrying about the downside. It is an insurance policy, correct or not? IRG requires you to pay premium. Those are expensive than FRS, correct? So FRA versus IRG. If borrower is certain that the rate is going to go up, he should take FRA. But if he is uncertain whether the rate will go up or go down, right, he should use a IRG. Depositor, if he is worried about interest rate or he certainly knows interest rate is going to go down, take FRA, right? Because IRG is a bit expensive than what FRS, right? Then interest rate futures. Interest rate futures are very straightforward, right? Buy futures is to right to receive interest at future date, and sell futures is right to pay interest. So as a borrower, correct, whenever I sell futures now, I will have a right to pay interest at predetermined date on a future date and close the transaction with buying future at transaction date, that is right to receive interest. So if 5% is the right to pay interest ka what promise and closing at 3%, right, paying 3% or receiving 3%, then there is a loss. But if 5% pay ka promise and 7% may receive ka promise during closing, you will save 2% ka profit, correct or not? Right? Then depositor, buy futures now, right? That is right to receive interest at 4%. And aage jaake, if you close it with 3% sell or pay, right? In that case, 1% will be profit and 6% and 2%, right? That means there will be a loss here if you have to pay at 6%. You have to remember only what the sell and buy strategies. Now see, how do you remember this? Okay, the borrower always pays interest. ये मतलब क्या, sell or buy? Tell me. From my pocket I am bringing something outside. That means what? Sell or buy? Sell. This is sell. This is buy. He is paying interest, so he will sell futures now. Later on, buy it at the transaction. Depositor, he always receives interest, so he will buy something, buy futures now and sell it on the later. Correct. Then yield curve theory. Yield curve theory. देखो जरा. What is the yield curve theory? Yield curve theory says two things. What are the 2 or 3 things that yield curve theory says? Okay. Liquidity preference theory. The yield curve is generally upward sloping. Why it is upward sloping? Because of the 3 theories. Liquidity preference theory is what? The higher the amount of liquidity is taken away, the higher amount of time the liquidity is taken away. So generally, I ask you money for 1 month, 2 months, you will give me money, correct or not? Without any interest. But if I ask for 1 or 2 years, you will ask for interest. If I ask for 5 years, you will ask for higher interest. If I ask for 3 years or 10 years, right, you will ask for more interest. The more liquidity I take away from you for more amount of time, the more interest rate will be charged. Then market segmentation, there are different players in the segment, right? There are retail investors, there are wholesale investors, and then there are unit trusts, right, and mutual funds and insurance companies which have different interest rates, right? So generally, if you invest with what, your insurance mutual funds over 10-20 years, you get a very good return, right? But when it comes to what, tell me, your this, what do you say, retail and wholesale, generally you invest for 2 years to 10 to 12 years, but generally insurance companies, what, you invest for 20 to 25 years. Then there is a kink that is there between, right, 2 segments, right? It happens because the market forces are weakest here, because the retail sector wants to enter the wholesale market or wholesale what segment, and the wholesale segment, whoever is starting will have a lower return. That is how the kink is there, and it is because of market forces are weakest here. This question is very famous and has been asked twice in exam, right? Why is there a kink in the market segmentation theory, in the yield curve theory, right? So that is how it is. Then expectation theory. Expectation theory says you expect more return in dollars, right? If interest rate is same in differing levels of bond, where life of bond, see, if there is a bond of 1 year, correct, it will give you 2% return. But if the bond is there of 2 years, it will give you 3% return, right? This is because of the more time the money is invested, the higher return you will expect. This is your expectation theory. Then come to business valuation. चल 1 minute. Business valuation, reasons for valuing a company or business, correct or not? Types of valuation of company, right? Now, what are the reasons for valuing a company, correct? Okay, I'll give you a break. Five minutes, I'll give you a break. There are three reasons, right? You want to buy or sell a company, you value a company. If you want to buy or sell shares in a listed company, and companies are valued at stock exchange or for IPO, then it will be there. And if shares of unlisted or unquoted companies to be bought or sold, correct? Then asset based valuation, this is very easy. Net asset value, three what methods are there? Net book value, net asset value, net realizable value, and replacement cost. Net book value is nothing but simple, straightforward. All asset minus all liabilities. Non-current asset, current liability, non-current liability. Right? Add current assets, non-current assets, deduct non-current liability, current liability, or you could say add equity share capital plus reserve. Correct? So you will have what? Tell me the net book value. But net realizable value, what you will do? Every net current asset or non-current asset or current asset, you will take the realizable value given in the question, right? And every current liability and non-current liability also, you will take all realizable value, deduct it, and you will get what? The net realizable value. Correct? We have done one question on this. 2-3 questions are done here. Then when it comes to what? Your replacement cost approach. The replacement cost approach is very what? Straightforward. Replacement cost is what? Tell me. Replacement cost, very straightforward. Replacement cost says what? Whatever is there is major asset stripping happening. What is asset stripping? Some companies are bought for their what? Very good asset conditions or very good assets that are there. So what you do? You buy the company for the asset and not for the full company. So whatever is the value of the asset will be the value of the company. But there are no practical questions on this at all, right? And last but not the least, PW ये तो नहीं करना, right? चलो, we'll take a break. P ratio का valuing the company 380. Come back by 3:45 p.m. 3:45 नहीं, जल्दी आ जाओ, 3:40 आ जाओ, right? We will complete this business valuation and then move to theory chapters, right? So quickly join it. We'll complete it. Okay. Business valuation. Quickly join it. By P ratio method, correct? So by P ratio method is what? P ratio is nothing but MPS by EPS, right? When you multiply it by the number of shares, you get what? Market capitalization or total market value of the company, of equity shares of the company, or market capitalization divided by EAESH, correct? Or total market value. If you have to rearrange the formula, you will get P ratio into the EAESH will give you total market value. Divide this by number of shares, and you will get what? Tell me, per share value, correct? This is how you find the value, and generally you will do what? Tell me, the EAESH that is there. You just only don't take the existing EAESH, but you take the EAESH, expected EAESH, correct? That is, if there is any savings, right? But you have to add anything you add in the EASH has to be after tax. So after tax savings or any after tax extra cost have to be added into the EASH of the old company that is there after it is merged in the new company, correct? Then you have what? The equity value by DVM approach, right? This stuff will be done tomorrow also. We have derived the formula by what? Doing this, so you can do it, right? We have, I think, notes for this differently given. Business valuation from here are the business valuation notes. So here, what do you do? Have a look. This is P ratio based valuation. Right? So you take the existing EASH plus the cost saving or any cost done, but you will take after tax everything, correct? Then you have earnings yield. Earning yield is nothing but EPS by MPS, right? The same thing, EASH by the earnings yield, you could find what? The equity share value, correct? Then you have what? DVM approach say you find with growth if there is P0 is equal to D1 upon K. Now here there is a catch. Okay, the catch here is basically you always will take what if the dividend is declared but not yet paid. In that case, you will take the cum dividend share price as your market value. Correct? Have a look. So if dividend about to be paid, then take cum dividend share price. If dividend already paid, take ex dividend share price as your market value. Correct? Have a look. Correct. The valuation of preference share, right? You have what? The market value of preference share. You use the formula KPS is equal to D1 upon market value. Right? Market value is D1 upon KPS. Valuation of debt also. Now for valuation of debt, for irredeemable debt, what is the value? KD is equal to a market value of loan note. Is interest on loan. Generally, from investor point of view, whenever you do the valuation, you will never consider what? Tax rate, right? So you'll take KD also before tax. You will also take interest on loan note before tax, correct or not? Then when it comes to redeemable also, you will take interest before tax and you will take KD. You will do what? KD ka. So interest before tax, redemption value, total cash flow, and then discounted by the KD before tax. That will give you a market value of loan note. That is it. Now have a look. I have given this table. This table also helps you solve a lot of questions, correct? When you have to do KD for WCC of a company, you have the market value of loan note, interest, cash flow after tax. You take redemption value, convertible value, whichever is higher. With the IRR approach, you use and find the KD 1 minus tax rate. But when they ask KD for investor point of view, market value of loan note given interest, cash flow before tax, right? IRR approach, so you find KD, right? But when you have to find market value of debt, interest, cash flow, you have to take before tax, redemption value, right? What? See, for when it is for WSCC section C question, then you have to do this, right? When it asks for market value of debt, you use this. And if it says calculate KD, specifically says KD for investor point of view, then you can use this part, this one. When it says find market value of debt, you have to do everything before tax. Your answer also will be KD before tax, correct? Have a look. Whenever in valuation of equity or debt, always come dividend or come interest price. Dividend declared but not paid or interest about to be paid. And whenever cost of equity, KE or KD is to be found out, correct? You take X dividend or X interest price. Then another method to value your company, is by the free cash flow method, right? The sales minus variable cost gives you contribution minus fixed cost minus depreciation give you PBIT minus tax and minus what? Tax. After that you get what? Profit before interest but after tax, and then add back the depreciation, you get operating cash flow after tax but before interest, that is without payment to the interest or to the debt holders. Then whatever other NCA or other cash inflows and outflows that will happen. So first you do all the profit and loss ka balance sheet without or profit and loss ka working, right, and get it to the cash flow by adding depreciation and not deducting interest, right? And then you take all the cash flows from the balance sheet, that is if any new investment is done or any old asset is sold and any loan taken, loan repaid, everything, and get the free cash flow to form FCFF, that is both debt plus equity, right? And this will be either invested today, right, up to perpetuity or will grow till perpetually, right? In that case, use the WACC to discount this and get the value of the company. Divide this by number of shares and get the value for equity share. Second option is you have to deduct the interest cost and everything, correct? Right? So you get that value of firm, usme se value of debt, you decrease market value of debt, you get the value of equity. But other way is what? Using the FCFE or what? Tell me. You get the deduct all the cash flows of what? Debt, right? And get the what? FCFE, correct? And then do your work, correct? Now it may so happen at times that it will be with growth and without growth. With growth hoga, so we will have to do net cash flow into 1 plus growth rate divided by WCC minus G if it is 0 year cash flow. But if it is 1 year cash flow given which will grow from second year, then you will take D1 or the cash flow 1 and growth rate will not apply. Correct? Have a look. You can go through this. Everything I have given quite detailed. Right? Have a look. Then you have efficient market hypothesis theory, that is there. Behavioral finance, that is there. Behavioral finance. What is behavioral finance? Have a look. You have something called as herding. Herding is what? Right? Psychology of investor plus rational. Before I go ahead, if you want to sell a small chunk of shares, okay, which method will you use? So asset-based valuation, isme the lowest value of company is the net book value. So if anyone says, what is the bare minimum you want to have for your company? Net asset value will be the bare minimum that you want for your company. Correct? Now your internally generated goodwill, not included in asset, goodwill purchase hoga, so it will include in the assets. Then going ahead, you have what? Tell me when equity share, more than 50% equity shares are to be sold, P ratio should be the method that should be used. Then when 5 to 15%, that is small chunk of share is to be sold, use DBM approach, correct? Then this, what? Tell me your valuation as per FCFF or FCFE, correct, will be used when you want to find maximum value of the company. Highest value that will come from PV of cash flow method, correct or not? Then you have what? Theory wala part of behavioral finance. This what? Tell me. Behavioral finance, psychology of investor plus rational decision making, right? So herding is what everyone wants what or follows the herd and buy or sell. So what do you do? Generally you listen to anything anyone says and try to follow that. Everyone follow that. Someone says Reliance shares best, buy Reliance shares. Everyone starts saying buying Reliance shares without doing any what research. Noise traders, correct or not? They do not base their decision on what? Rational analysis, correct? They what? They base their decision on the noise about the company. If very good news or news about the company is coming in the market, they will buy that, correct? Loss aversion, right? That means what? Investor will prefer short-term gains. I tell you that one company, you hold the share for 10, 15 years, right? Don't lose the share ka grip, correct? But if you see short-term and also you sell that share, correct? Have a look. Then you have something called as EMH, efficient market hypothesis. Efficient market hypothesis is nothing but good or bad news about a company, correct, has effect on the stock prices of the company. But if a market has no impact of any good news or bad news about the market, it is called as a no efficiency market, right? there will be no reflection of any information of outside world on the share price, right? And share price is randomly what? Tell me, change, right? No information reflected on the share prices. Have a look. This is a very important table. I think the whole EMH can be explained here. If you analyze the technical part, that is in this no efficiency में the old share prices movement. So technical analysis is old share prices movement. Fundamental analysis is checking the what profit and loss and other details of the company. If you analyze the technical part, that is change in share price in the past, and try to make a forecast for the future, you can make super profit. Correct or not? Weak form efficiency. What is weak form efficiency? Tell me. Where information is reflected, but it takes a bit of time. Correct. So if information reflected, it takes a bit of time, right? So impact on the shareholders will, or there is a delay in the reflection of published information. But when it comes to what here, tell me. Yes, I'll do that. Okay. So your share prices are not based on what technical part, that is change in the share price in the part in reflects the news, but on a later period. So if you get the information earlier than everyone else, then you can make a super profit in this what market where weak form efficiency is there. Then there is something called as semi-strong form efficiency. What is semi-strong form efficiency? Where the news which gets out directly has an impact on share price. Here you need to have insider information to make super profit. Correct? When it is strong form, everyone knows everything. There will be no impact of any good or bad news on the share prices, and you can make a super profit only by luck. Correct or not? Right? So someone said momentum effect and what? Tell me. Market paradox. Correct or not? Momentum effect is very simple, right? So you feel the share is going to go up, right? The momentum is going up. You start buying. That is momentum effect. Correct? Market paradox I'll take tomorrow. Okay? Hey, अपने पास somewhere in the notes market paradox also will be written. Efficient market hypothesis I have done. ठीक है. उसके बाद डिविडेंड पॉलिसी तो कल करेंगे विथ व्हाट WACC. I'll complete the other part. FM remainder theory part 1 कर लेते. Part 1 कर लेते. आ जाओ. I've already sent you that part. Correct. So पहले तो it is from the first chapter FM function chapter managerial remuneration वाला part. Correct. So goal congruence, there has to be a goal congruence between shareholders and directors, right? Like they both have to be in the same line. Correct. For managerial remuneration, that you need to define the reward scheme. You need to have 4 points. It should be clearly defined, impossible to manipulate, easy to monitor, and link shareholder wealth maximization with the rewards. Correct. And match time horizon of manager and shareholder. Because manager always thinks one year or 2 years, shareholders always think 5 year, 10 year, 20 year. Managers should be encouraged to take more risk like shareholder. Correct. Then you have what? Executive or employee or ESOPs, correct? In ESOP, generally you have to work for certain number of years to be eligible for ESOPs. ESOPs are employee getting what? Or the shares of the company in what? Tell me. Basically, at a discounted price in the market value, correct? So equity shares, then employees after applying for ESOPs will have to sell the shares only after a mandatory lock-in period, correct? And they become part owner of the company. Advantages and disadvantages of ESOP, not a section C important question, but A and B may somewhere or the other they can ask you this, correct? Right? Then employees will get a sense of ownership in the company. Company will be able to raise capital through the ESOPs, but disadvantage is no direct relationship. The employee may work as much as he wants, but directly share price increase will not happen, and the share value may go underwater after the ESOP issue. And lock-in period may not apply to directors, and they may immediately sell the shares and get the profit. ESOPs may lead to what? Dilution of control. You might just read it once. Corporate governance, 5 important points that are there. 50% or more of the board of directors should consist of INEDs, that is, independent non-executive directors. Chairman of the meeting and the MD of the company should not be the same. Audit and remuneration committee should consist of only INEDs. Every director should nominate himself for reappointment every 3 years, and sitting phase is paid for the INEDs. No salary is to be ever paid to the INEDs. Correct? Not-for-profit organization has 3 economy, efficiency, effectiveness. Generally, economy is based on input. You want to buy what? Cheapest option, but the best quality. Not that cheap means the quality will be less, right? economical inputs, efficiency, efficient processes, and effectively fulfilling your what? Tell me your objectives, correct or not? So you have general questions where what is economy or whether that aspect is related to economy efficiency. So when I say first, there was a system where 10 patients were what generally for not-for-profit medium organization or trust this is used. So what happens? 20 surgeries a day you could do, now you could do 40 surgeries. So a good efficient process has been what hired, correct? Or has been applied. Effectiveness means we had to help 5,000 patients and we served those 5,000 patients, that is out. Then there is something called as FM environment. A lot of students leave this FM environment and the FM market spot. The niche FM markets is also there and end up losing. See, you get 46, 47. Why? These 2-3 MCQs or 1 or 2 MCQs that come from this chapter, this FM environment and that FM market, right, are really crucial, right? FM environment, what are the macroeconomic targets? Macroeconomic targets are very simple. Achieving economic growth, that is GDP growth, and full employment of all the resources. There has to be a price stability or control of inflation. Positive balance of payments, that means export should be higher than the import, correct? And equal distribution of wealth among everyone, correct? Then if government wants to achieve the macroeconomic target, it can do so by controlling 3 policies: fiscal policy, forex policy, and monetary policy. Forex policy के में there are 3 policies. There is a controlled forex policy where company or where the country or where the government itself decides what will be the forex rate. Uncontrollable forex policy where government lets the market decide as per demand and supply the rate of what? Forex. And then at the end, minimum regulated what? Tell me. Forex policy means what? Wherever possible, they will regulate, but most of it is uncontrolled, correct? But coming to fiscal and monetary policy is more of dependent or based on government spending, borrowings, and taxation. And monetary policy based on money supply, interest rate. So in fiscal policy, if you are following expansionary fiscal policy measures, that means you want to expand the economy. In that case, government spending or borrowing will go up and taxation will go down. Because of the government spending going up, the economic growth will be higher. If government is spending a lot of money, then there will be an aggregate demand which will increase, and thus people will have more money and purchasing power will go up. But if there is a contractionary fiscal policy where government wants to what shorten the what tell me or make the economy smaller, correct? Then what will happen? The government spending will reduce and taxation will increase so that excess money is taken away from the people. It helps in control inflation and aggregate demand goes down and purchasing power goes down. The problem with fiscal policy is 2 problems. One is crowding out and one is tax incentive, correct? Crowding out is very simple. What happens generally, the risk-free rate is lower and the risk rate or the risk of market or return from the market is higher. But if government starts giving higher return on the risk-free rate, a lot of people will switch money from equity market to the government securities, and it will lead to what? Crowding out of people from the market to the government securities. Tax incentive is what? Tell me, a very high tax rate, correct? Might be a demotivator for what? A lot of so government policies, right? Very high tax rate is a disincentive to work, correct? Tax incentive may not be a very good or very high tax rate may not be a very good option, correct? That is that. Then monetary policy, correct? Monetary policy, expansionary and contractionary policy. Expansionary policy, monetary policy measures means money supply and interest rate. Money supply will go up, interest rate will go down. So interest rate goes down, people will borrow more, so more money supply in the market. The reserve ratio is nothing but how a bank has to keep something with the RBI. If the reserve ratio is very high, there will be no money with the bank. But if the reserve ratio is low, there will be a lot of money with the bank. Hence, money supply, if you want higher in the market, the reserve ratio has to be low. Government buys the securities what from the banks, and money supply is increased in banks, and public will get more money. So money supply increases, there is a investment in production, export increases, the balance of payment will increase, and there will be a decrease in forex rate because there will be a lot of demand for or a lot of foreign currency will be received, and there will be what decrease in the forex rate. But if there is a contractionary policy measure, money supply will be reduced, interest rate will increase, so people will not have so much access to what loans and all those things. The interest rate is very high, so no one will what take a lot of loan. Reserve ratio high means a lot of low money will be there. More reserve to be kept with the RBI, so less spendable money will be there. Then government selling securities, right? Government will buy all the securities, correct, from you. So your government will sell you securities and take all the money from you. So money supply will be lower, right? Then the money supply is lower, investment in production is lower, export is lower, balance of payment will go down, and forex ka demand will increase, correct? Because your import will be on the high, right? Then reserve ratios, types of inflation, demand pull inflation. The demand goes up and it leads to price going up, hence inflation going up. The supply is obviously lower. Cost push inflation, that obviously the cost of certain goods or certain inputs goes high. You have to increase your selling price. There are 4 types of competition policy: monopoly, duopoly, cartel, perfect competition. Monopoly is one single seller, is the price setter. Duopoly, 2 major sellers, they set prices. Cartel is seller make an illegal group and what set prices. Perfect competition, market forces decide the price and not the what people. Then FM markets, right? You have now see this part. You must have seen 10 to 12 MCQs on this. This or iske baad what we are doing, types of competitive, FM market type of stuff, correct? This is included in FM market, FM environment only, correct? So you have financial intermediary, and there are the basic is basic financial system has 3 things: market, institution, and security. That is okay. My thing would be benefits of financial intermediary. So financial intermediary is what? Generally bank. Bank has 3 things, right? Maturity transformation, it will take short-term deposits from depositors and give long-term loans to what? The borrowers or the lenders, correct? And they will take a short-term deposit and make it into a long-term borrowing. There will be aggregation of funds. Small value of deposits will be taken and large borrowings will be done. Pooling of losses. Risk of individual depositor is reduced, because if directly you invest into some business, if that business fails, the whole money will be lost. But if 10 people invest into a bank, bank will also invest in 4 or 5 people or 20 people, different people, and 1 or 2 may lose. Everyone's money will, only part of the money will be lost, not the full money. Disintermediation, so traditional system. Disintermediation is what now banking goes out of picture and people can directly invest into the market through a stock market or there are other platforms. There are 2 types of market: primary market, where primarily shares are sold, right, by company for the first time, right? And then there is a secondary market. Secondary market is where selling and reselling of shares happen, correct or not? FCFF, when cash flow given in the question, correct or not? Cash flows and all, profit and loss and everything given. They will specify that either do it by FCFF or get the highest value of the company, right? Then you have to use FCFF formula. Secondary market ho gaya. Then you have this what? Financial market ka what I have, I think better done here in the notes. I have written that. आ जाओ जरा. Types of financial market: money market and capital market. Money market is generally less than 12 months short-term assets or investments. Capital market is more than 12 months life, right? Then in the capital market, right, you have 4 what instruments: equity share capital, long-term ownership of the company, correct, unsecured but very risky, debt or loan note or bonds or debentures, generally long-term, secured or unsecured, compulsory interest payments are the euro bonds are generally bonds which are issued in what? Tell me. Currency other than the home currency. It's not euro bonds, correct? Euro currency loan means you are giving loan in what? Tell me. Or you are taking loan in some normal loan taken by company in other than the home currency, right? Then coming to the money market. Money market may you have certain instruments. What are the instruments? There are interest bearing instruments and discount bearing. Interest bearing may what? Money market deposits. Generally, money market deposits are done between banks, correct? And they are non-negotiable instruments, correct? Certificate of deposit are generally short-term instruments between bank and investor, 30, 60, 90 days, secured by bank and negotiable. It is a negotiable instrument. Repurchase agreements. You sell something right now to someone, right? Because you need money, and later on you are going to repurchase it. It is a non-negotiable instrument. But when it comes to discount bearing instruments, right? Discount bearing instrument, treasury bills. Treasury bills are generally government securities backed, government backed securities, correct? which have a low interest rates but are very secured, right? And short term generally 10 to 90 days, and they are negotiable instruments. Commercial paper. Have you heard all these terms? Did you know all these terms even existed in your syllabus? Tell me.
Yes.
Negotiable means what? Tell me. You can easily sell it somewhere. Correct. Did you know that they can be asked what is negotiable, what is non-negotiable, whether it is secured, unsecured? Have you seen MCQs of this part? Theory. But you tend to ignore it. Theory MCQ. Ignore it. Right? So commercial paper, large corporation, security based. So this is commercial paper that generally issued by large corporations to investors. They are negotiable instrument means what? Tell me. They can be easily transferred by taking money. Right? Unsecured, that is there is no security. Correct or not? Tell me. Then unsecured, that is no security against any asset, large amount of issued up. Right? Acceptance credit, bills of exchange with bank or financial institution, corporate. Generally, these are bills of exchange. These are unsecured, short-term, non-negotiable because acceptance credit cannot be. But bill of exchange are negotiable. Correct? Right? Bills of exchange are generally promissory notes or other instruments where promise to pay is mentioned. Correct? That is there. Then I think treasury function yesterday we saw. Right? The treasury function advantage, disadvantage. You can have a look at it. Right? इसके बाद I think there's nothing in this chapter. Euro bond वगैरह हो गया ना? Euro bond, Euro loans, treasury functions. You can go through treasury function once. Advantages, disadvantages of centralized and decentralized. Learning करना है, correct? Treasury function. A lot of people say that section C में नहीं आएगा, but I'd like to differ. Maybe advantage, disadvantage. You might see treasury function somewhere. ठीक है. Dividend policy, remaining salary में इतना डालो. The supply side policies, what are supply side policies? Where see generally what government does is goes into various different क्या था भाई this what do you say different areas, and they try to tell me develop that area. Instead of that, if private organizations go there and try to tell me flourish the economy or develop the economy there, then in that case, right, क्या होगा is to be encouraged. Tax rate should be kept to the minimum and government expenditure should also be. So government should not do. The private companies will go and develop those areas, right? So monetary policy is used to control inflation. देखो problems, right? वो policy है. Government will not interfere there. Private companies will go, right? Deemed more efficient at providing output required than the public sector, right? So, but the problem is there is a time delay before the policies have an impact in the private sector, right? Private sector will not give free goods or not give services, right? Free of cost, there will be no service, correct? Then securities token offering, STOs, right? STO is very simple. Now see, STO uses blockchain environment. Blockchain environment में क्या होता है? If A sells something to B. Now see, right now if you see, there is a flow of money. I give you money, you give the money to someone else gives the money to third, fourth, fifth. A layer is made. Can I follow the money and find who the money is going to? Yes. But when there is a blockchain environment, they block the chain in such a way that when I give you the money, right, my identity is encrypted and no one can trace the money back to me. Then you give the money to someone else, your identity is encrypted, right? And the biggest problem with this kind of transaction was that these kind of instruments, let's say your coins, Bitcoin or anything, are not secured against any asset, right? That was the biggest problem because Bitcoin no one knows. They are mined and they are secret currency, correct? If tomorrow there is no market for Bitcoin, can you go somewhere and ask for money against the Bitcoin? No, it is all digital money, correct or not? So government bought in legislation, right? Where these Bitcoins, correct? Now see, right now you see shares. So no, two things the government took. One, Bitcoin ka blockchain technology, correct? And the other is negotiability of shares. So what happens generally? Now see, if I have to pay you 10,000, right? I can pay you through my Paytm wallet, through different wallets, correct? I can pay you through the direct debit card, credit card, right? But I have I want to pay you in shares. Can I pay you in shares? Tell me. Can you pay your fees in shares to me? You have shares of Reliance. Sir, take shares of Reliance. No. But to get that negotiability of shares, that shares can be easily sold, right? STOs are nothing but what? You have shares in the company which are now sold as security tokens, which you can easily transfer to anyone, right? So now if you want to make a payment to me and my shares or security tokens are listed on the stock exchange, you can pay to me STOs, correct? STOs, digital negotiable shares. एक बार आप read कर सकते हो, correct? Right? Then how to do a STO issue, right? There are 5 what? STOs are regulated. ये भी बोला है, right? The old you might have what? The other tokens, any other tokens that are there are not government what regulated, but STOs are now government regulated. Now first you prepare what? Whenever you do an STO issue or a share issue जैसा ही है, correct? You have to prepare what? A deck. Deck means what? For all the information, what is going to be your business plan, or in normal terms, it is a prospectus. Then you design the offer, how many STOs will be given, what will be the value of the STOs, and what will be the rights of the STO. Then you have to, this is a blockchain technology used, so there will be a provider who gives you this blockchain platform. You have to contact him that these many what STOs have to be issued and this will be the value and everything. He will then prepare the what backend mein whatever server or whatever is required through which those coins can be mined, correct? Then you give it to the investor, right? Take the STOs and raise the capital, and at the end, listing of securities, whatever securities or STOs you have listed or you have issued, list them on a stock exchange, correct? This is how STOs work out. Then there is a question of what? Problems of high financial gearing. You have bankruptcy risk. If you have very high financial gearing, what will happen? A lot of losses will incur and there will be bankruptcy risk that is there. Then there is agency cost or restrictive conditions. The bank will not allow what to you to pay what? Tell me. Basically dividend before paying interest, correct? Or they may also restrict further payment of dividend before interest is not, correct? Then debt capacity will reduce. Obviously, if you have very high gearing, debt capacity will reduce. There will be increase in financial cost. Up to certain level, you will get lower KD. Then after that, KD will increase. And then there is tax exhaustion. You say that interest gives you tax savings, but if there are no profits only, there will be no tax savings because of interest. Correct? Have a look. I think with this, your what revision of small chapters, which problems of high financial gearing has come in section C before, but supply side policies, security token offerings, generally section A or B questions, correct? Problems of high gearing, theory question for section C, important. So with this, I think your foreign forex risk, interest rate risk, but certain times company does not do that. If it does not have money to pay interest, it will, or does not have full money to pay interest and dividends, it will sometimes pays dividend first, correct, and then pays interest. Over the counter means I go to the bank and give the what? Tell me, as my invoice, and they cover that invoice. So over the counter, right? I go to the bank and for my transaction I receive a special what? Quotation, right? That is how it is, correct? But when it says stock market, right, means options and futures are listed on the stock exchange. So with this, I think we have finished the revision of what? Foreign exchange risk, interest rate risk. It is not tradable, obviously, because over the counter it is a contract specifically or an offer specifically for you, correct? So it will be non-negotiable or not tradable, correct? Right. Chalo then guys, let's wrap it up for today. I hope fast revision abhi aaj all forex and interest rate risk, right? And what? Yes, generally short term, correct or not? So foreign exchange, forex, interest rate risk, business valuation, and all theory chapters, right? I'm telling you this might be 20-25 marks worth of portion today. Agar 2 section B question come up, 20 marks. 2-3 MCQs on that FM environment function, right? 4 to 6 marks. 25 marks ka revision. But this is the 25 marks where every student is not too confident, correct? So accordingly, what? do the things. Okay. Chalo then guys, let's wrap it up for today. We'll meet tomorrow. Tomorrow, remaining part of the question will complete and wrap it up. Right. Tomorrow at the end for 15-20 minutes, I'll also tell you how to write the paper, how you should write the paper, what should be the time within which you should complete everything. Okay.
Okay, sir. Thank you, sir. Bye, sir.
Bye bye
Thank you,
guys.
sir.
Take care of your health. I'll try to upload it in the evening.